It's a very confusing market. We're seeing stronger than expected and objectively relatively strong economic data, but we're also seeing a market that sells off very aggressively. Why is this? Well, this is because we're dealing with a problem many of us haven't seen in our lifetimes. And this country has really only seen one other time and had to fight in this same kind of way that it is right now. And that is inflation. And inflation is the ever prevailing factor in this market. However, what has happened over the past year plus might not necessarily be what's going to happen in the future. And that is the notion that the economy is strong. I think the Fed is going to get its way, and it's going to get its way by achieving its objective, which it claims is to get demand and to supply back into balance. And my opinion on that, for what it's worth, is such a process won't be so smooth. And it seems confusing. Everyone is looking at the CPI data. They're seeing it come down in a very strong way. They're seeing the economy, like the Fed said yesterday and today, particularly yesterday in the minutes. They're seeing the economy be very strong in the first quarter, reaccelerate in the first quarter, and they're hearing the last set of earnings reports and thinking, well, they're getting inflation down. They're seeing an economy strengthen. Soft landing must be imminent. We should buy stocks. Fear of missing out. I can't blame anybody for thinking and believing that and going that route. That is a very sound route to go. However, I don't think it's going to be maintained. And I think really listening to every word the Fed says, connecting all of the dots, makes it clear that the message is more not we're almost done, soft landing achieved. The message is more that we have a long way to go. And even when interest rates get to neutral, QT, the shrinking of the Fed's balance sheet, is going to continue. So we are far, far from over on this tightening question. Now, the economy, strong in Q1. Can we expect that to continue, and should we possibly even expect that to reaccelerate? I don't think that's the case. I just listened to the CEO of Amazon. He doesn't sound very positive. He's not saying the consumer is very strong. What he is saying is consumers are trading down every time they can. We have to remember what we got in Q1, the last set of earnings reports. Those are now more than 3 months stale, okay? And what ultimately matters is not necessarily trailing earnings, although those can typically be a good guide for future earnings, but what matters is future earnings. That's what matters. So, I'm not liking what I'm seeing. Levi's just slashed their guidance. That is a retail company. That works very well in conjunction with Nike, who slightly missed their guidance, or slightly missed their earnings, but also did not sound super positive on forward guidance. These companies are having year-on-year, sizable year-on-year declines in earnings. Nike's was roughly 30% year-on-year decline in earnings. Apple projecting additional declines in earnings. This is a thing. This is a thing that earnings are going to decline. And if prices are equal and earnings come down, PE ratios go up. However, prices are not equal. Prices have gone up, so that's even more pressure on upward pressure on PE ratios. And PE ratios are very, very, very high right now. They're unconvincingly, in my opinion, high to buy. The amount of bang for your buck you're getting is very low. At the October lows, it was starting to get interesting, but 15 times forward earnings, that's, you're waiting some 15 years, give or take, to maybe get your money back, assuming all goes according to plan. That number, 15.2, that we experienced at the October lows, is higher than it was at the great financial crisis '07 peak. So it's not cheap. Right now we're at 19 times. This is something that we have seen a few times, particularly in the COVID bubble, when there was a phrase known as "there is no alternative." When it made sense to, instead of for a huge retirement fund or elderly people, to buy a stock like Apple, to buy a stock like Microsoft, instead of buying a treasury at virtually 0% when the Fed was printing all this money. There was no alternative. That was the phrase that was used. TINA. Look up TINA. What does TINA mean? There is no alternative. That was the message of the market at that time. However, there now is an alternative, and it's breaking out, and it's called, take your pick on your timeline, the 3 month, the 1 month, the 6 month, the 1 year, the 2 year, the 5 year, the 10 year. They're all offering you sizable returns, and they're locking them in, and they are state tax free, and they're no risk. The risk-free rate of return is going higher. So when the price of risk is very high, it begins to make less sense when the price of no risk goes up. That's, don't hate the player, hate the game. That's the way it is. So definitely an important thing. And it's not just the interest rate factor that matters. There are downstream effects of higher interest rates. They are intended by the Federal Reserve to slow down the economy, to make people question, should they borrow that dollar on that credit card to buy that new TV, or should they not? Should they trade down to that lower end product like Andy Jassy, Amazon CEO, says consumers are doing every chance they get, trading down? So these are generally not positive signs. And a lot of people want to dismiss the idea that we can see this earnings slowdown, see a possible recession. We are experiencing an earnings slowdown despite positive GDP growth, though, because simply it hasn't happened yet. I think we need to not regard that straw man in high order. And why do I say that? While many who thought a recession might have come last year are clearly wrong, the truth is a rate-induced recession, and this is, we're taking out all the past, what hasn't happened, all that kind of stuff. What would cause a rate-induced recession is rates entering restrictive territory. We're taking out all the noise here. Rates began to enter restrictive territory in Q1 of this year. So we're starting to see the pressure of interest rates hitting the economy. We're starting to see it. It's still early. There's still more rate increases to come, which are intended to have the effects of slowing the economy. I don't think we can cancel the recession until the Fed starts cutting. If the Fed starts cutting and there hasn't been a recession yet, there probably won't be a recession. But until then, and we have about over a year until then, we got to keep going. We gotta at least hold it. It's a very sizable probability, and I think it is. Regardless of whether or not a technical recession occurs, I think margin erosion will continue. That is something that is objectively occurring, and I expect it to continue. So, I think forward earnings might end up actually coming down because they're projected to continue to reaccelerate very shortly after Q2. They're expected to go up in the second half earnings. I don't think that's going to be the case. I am in the Mike Wilson camp that earnings are going to slow in Q3 and Q4 and probably continue into next year as well. I think, the first half of next year probably going to be weaker than the second half of this year. I think that's the case. I think an actual downtrend in earnings is currently occurring, and that is absolutely not the view of the market. That is an anti-consensus view. I've had a tough year. I'm not going to hide away from that. But, you really got to view these things, I've learned, on longer time frames, I guess. Macroeconomic situations. Very difficult to predict. Very slow. But I'm sharing you my best views. And some people don't want to focus on the macro. Warren Buffett doesn't want to focus on the macro. I think that's more because it's hard to predict rather than it's a good idea to not listen to it. Obviously, it's a good idea to be focused on the macro, focused on interest rates, which Warren Buffett would say are important, and various other things. So I don't think it's possible to call the recession off yet. I understand. It's been a very confusing year. It's very easy to say, oh, it's been so strong in the past, it should be strong in the future. If we remove all the noise, all the signs, everything, we just focus on the facts, you can only have a rate-induced recession when rates enter restrictive territory, in theory, and rates just entered restrictive territory. So why would we have a recession last year? Doesn't really make any sense. So although I understand also why people expected a recession last year, because interest rates went up. Interest rates going up has more times than not, actually, believe it or not, caused a recession. But they just need to hit a certain level before they do. So that's the take. Tomorrow we get some data that may or may not make interest rates go higher, but they are definitely having themselves a move here. And watch yesterday's video for more information on analyzing the importance of interest rates. So that's today's video, and until next time, peace out.